All right. Thanks, David, and thanks for having me. Appreciate it. Um, always like doing some of the new things. Like I said, I haven't been, as you mentioned, I haven't been on this before, so I appreciate it. And I was looking at the list of people, and a lot of people I'm familiar with, a lot of really smart option people. So I feel honored to be a part of this list. So thank you, and welcome everyone. Real quick, a bit about me. I'm a options coach for NetPicks, which is research education, trading education company. My background a little bit different than than some others in this industry. I was a floor trader on the CBOE in the 90s. I started in the S&P 500 options pit, and then got on a seat in single stocks equities as a market maker. So really, my most of my career has been around options. I did some consulting on trading floors off the exchanges, so in banks. Then I went to business school. Thought I would try my hand at corporate finance for a while. Did not really. That was not my cup of tea. Most of you, if you've done any trading for a while, probably know that once you do trading, and it's got a lot of excitement to it, right? And stress, but also excitement. So I couldn't really get into corporate finance and management consulting and that sort of thing. It was too slow paced for me. So for the last 15 or so years, I've been doing what I'm doing now, which is research and education. Really like to focus on the education side of things, bringing what I know from being a professional trader to to a wider audience. Just teaching in general is something I really enjoy. I'm also a professor, teach economics and statistics at a local college here. So just kind of my passion really to teach. So that is me. We're going to talk about cash secured puts. This is one of my favorite ways to trade. And something I like to say right off the bat is that, a lot of people think, all right, well, maybe not just me, but anybody who's been a bit more, sophisticated or done higher level trading or professional institutional trading, it doesn't mean that you need to do complex stuff to make money. In fact, I think the general, in my opinion, over 25 years of doing this, is simple generally tends to be better, right? There are times for complexity. If you're a professional market maker working for Citadel or Jane Street, yeah, of course. I mean, every penny counts, right? But when you're a position trader, even a short-term trader doing options, right? It's surprisingly how much that your best strategy is often the simplest one, right? You find something that has an edge, and you stick with it, and a lot of times that's going to be something pretty basic. Right? I do a lot with cash secured puts and covered calls, two of the simplest trades that generally are the easiest to get permission to do, and after 25 years, I can honestly say I haven't found a lot more. No matter how complicated you get with options, that more successful in terms of finding a strategy and sticking to it. Right. So we're going to talk about, and it's a similar, if you're looking at covered calls, you're looking at cash secured puts or things that are related to that. A lot of this stuff is going to carry over, a lot of what I'm going to talk about. So that being said, let's get into it. Um, Judging by the people presenting here, I think a lot of you probably have plenty of experience with options, so I'll go through the basic stuff very quickly. It's just in case we have some new people here who have not spent a lot of time with options. Cash secure puts are simply having the money in your account when you trade a put to cover potential assignment, right? So the alternative would be a margin account, right, where you don't have to have the full amount. So I don't ever assume anybody has a margin account. That's just kind of a rule I go by. I don't expect people to get margin permission. So every product I ever have, for the most part, with the exception of some very advanced stuff, I'm just assuming people are going to have cash accounts and use cash accounts. It's a lot simpler that way. So you certainly don't have to, but it's easy to get permission. to trade this sort of thing. The goal here with cash secured puts, just like cover calls, is consistent cash flow. And we do that by collecting option premium. All right. Again, I'll go through this. Is just very basic option stuff, just in case um, you're you buy a put, you're looking for the right to sell a stock, right? We're taking the opposite side of that by selling a put. The seller must buy the stock if they're assigned. And your key components here. This is just a common option chain. This is from E-Trade, where you have your strikes and your different expirations, and then your premium amount. So I'm sure most of you have probably seen this so far. So I'm not going to spend a lot of time here. Okay. What makes it cash secured? Again, this is what I was talking about as opposed to a margin account. You have to do at least, so if you do a one lot, that's the equivalent of in this case would be buying, if you get assigned on a short put, buying 100 shares. So you have to have enough money to at least buy 100 shares at whatever strike price you sold. So if you sell a 50 put, you need to have $5,000, right? And, it's as simple as that. You just broker wants to make sure there's no risk to them, that if you get assigned, you have the money in your account. Right now, if you do a margin account, it might be 50%, or you might be able to use cash from other sources. I mean, it depends on your broker. Again, that stuff can get a lot more complicated and different costs and different rules, and that's broker by broker. So I just assume cash secured, and it's the easiest way. Generally, in order to keep it more capital friendly, I will focus on lower price stocks, but there's no reason you can't do this with a $500 stock, right? You're going to have a lot more uh, capital in your account in order to do it. So that's really the main drawback of cash secured, is it can be capital constraining. Okay, so now we're getting into more of the interesting stuff. Why sell cash secured puts? Well, as I mentioned at the beginning, you can generate cash flow from option premium. So I like to say cash flow rather than income. And I do use income a few times in this presentation. But for the second point here, complements income or yield focused portfolio. Yeah, so it can be good. Both cash secured puts, cover calls can be used to be help um, accelerate or amplify a dividend portfolio or something along those lines. But I like to use cash flow with options because it's cash flow is not P&L inclusive, right? When you say income, normally that implies you're making money, but sometimes there's going to be situations where you're selling options on something that is currently a losing trade, right? You're obviously planning on it being a winning trade at some point, but if you're getting cash from a losing trade, that's why I like to call it, because it's not really income if you're losing money, right? So I like to call it cash flow. I just think it's a little bit more accurate. Income is perfectly fine. The SEC is perfectly fine with calling premium from options as income, but I try to differentiate income meaning something that is positive. But so that's why I use cash flow here. All right. So with what we're going to talk about, assignment is optional. It's not the goal, and I highlight that because there are people out there, and again, there's nothing wrong with this. It's not the way I think about stuff. There are people out there who say, okay, well, use your cash secured puts as a way to get in a stock you like for a cheaper price. That's not how I look at it. Technically, that's true, right? But that's not the reason I think you should sell cash secured puts. I think you should do it because the options are expensive and you're taking advantage of that. It's a side benefit if you want to own the stock and you get assigned at a lower price, right? Or it may not even be a benefit if the stock keeps going down. But let's assume it's something you don't mind owning, right? I don't assume that's the goal. That can be part of the strategy. We'll talk a little bit at the end about the wheel strategy, but um, generally speaking, when I sell cash secured puts, I am looking at it as an option trade, not a stock trade. Right? Ideally, then this is going to happen in a neutral to bullish market. If you don't want to get assigned, you don't want to take ownership of a stock, then generally neutral to bullish markets are going to be better for that. Obviously, if everything's going straight down, you're probably not going to be one of selling puts. Now, there might be times when the market is going down where there's some opportunistic times to sell puts, but generally speaking, it's not a strategy you're using in a down market. Fortunately, most markets are neutral to bullish, right? That's the vast majority of the time. All right, so let's look at an example trade. This is United Airlines. So again, this is just a very simple example, but we're looking at puts about 3 weeks out at the time when I got these prices, about a 3 week trade. And I just, for example, looking at, let's say, the stock here, it's somewhere between 90, 91, and we want to sell the 85 put, right? That trade is going for a little over $2. So what that means is that anything above 85, you make your $2, right? Roughly $2, $200 for a one lot. As it goes down, you have $2 worth of cushion before you start losing money. And then below that, it's just like owning the stock, right? You lose as much as if you own the stock. So you have a little bit, when you sell the put, you have that little bit of extra cushion, whatever premium you got. So an extra couple bucks of cushion. And then after that, it's basically, again, just like owning the stock. All right. So let's zoom in on this a little bit. So the max profit is always going to be your premium received. All right. Your max loss is if the stock goes to zero minus premium. But of course, you collected the premium, right? So instead of from 85 going down to zero, you would be at 83 going down to zero. But let's be realistic. Most of the stuff we're going to do, for me, all the stuff I'm going to do is not going to go to zero, right? I'm never going to sell puts in a stock I think is going to zero. And something like United Airlines is probably not even going to 50, right? Unless there's a, alien invasion or something crazy goes on, right? We don't expect a huge drop in something like United Airlines. Maybe it goes to 70, worst case scenario, or down 20%, something like that, right? So really your max loss is probably not zero. I'm not going to say, we saw really strange things in 2008, 2009, and again during the pandemic. So, I mean, there are weird things that can happen, but for the most part, those are blips that, are obviously extremely rare. So I would not expect most stocks to go to zero. There are going to be, obviously, if you're going to sell puts on a stock that's already declared bankruptcy, that's a different story. That's your own decision. Sometimes that can work out, but at some point that stock's going to zero, most likely. So that's a different story, but that's not the sort of strategy that I use personally. Once again, your break even is your strike price minus your premium. So you do have a little bit of cushion there. Okay. I'm more of a short-term trader, but you can use cash secured puts for long-term. There are a couple of different ways to use this. If you are doing longer-term trading, then the fundamentals of the stock actually matter, right? Not a company, not the whole bankruptcy thing. Obviously, bankruptcy is a fundamental feature that you want to know about, but I'm talking about more of the common stuff, how liquid a stock is, how much cash they have, well, what are their earnings look like, what do their dividends look like, valuation, right? Margins, that sort of thing, what their outlook is. That stuff's going to matter if you plan on being in a trade for a long time, right? Because there's a point where either you might take ownership or at the very least, you want it to stay above a certain amount or go up. So if you're going to hold it, and I'll show you an example of this for like 3, 6 months or a year, or, something like that, then knowing more about the company is important. Right now, if you're going to do a shorter term trade, which I think probably most of us are shorter term traders with options, right? You might buy stocks. I know most of us buy stocks in our 401k or IRA or whatever, but in terms of options, right? Most people are doing options from a shorter term perspective. And so you don't need to care as much about the stock. You still need to know what's going on, and you need to know what events are going on besides just earnings, right? You need to know if, there's a company launching a product, or if there's a lawsuit that's about to be settled, or some, new product, get a new trial in a biotech or whatever, right? Obviously, you need to know about events that might happen while you're holding. You might want to avoid stuff that's heavily shorted, right? Sometimes that's an opportunity, but if you want to be safe, things that are heavily shorted, those overnight can drop quite a bit, right? In some situations. So just things you need to be aware of. And then I think the most important thing here is option liquidity, right? If you're doing a shorter term trade, then it matters where you're getting your fill price and if you can get in or out of it relatively quickly, right? So that becomes important. If you're a longer term trade, then you can take your time, set limit orders and give it a few days to get in or out or something, right? If you're going to be in for 3 or 6 months, it's not necessarily a rush for your entry point. If you're doing a short-term trade, really anything under a month, and particularly if you're doing it like 2 weeks or under, then yeah, the pennies start to add up and they start to matter. So liquidity becomes important. All right. So talked about slightly longer term trade. Here's an example of one with Tesla, trading $444. So this is about a 3 month trade, January out to January. It's roughly 3 months. So this might be so. Let's say every 3 months you wanted to sell a put on Tesla. You could go pretty far out of the money and still get some premium because Tesla is obviously a more volatile stock, right? It moves around quite a bit than something like Walmart, for example, right? So 325 strike, that's quite a bit a ways, right? That's not quite $125 away, which is what is that? 3, 4, I mean 25%, not more, 30%, 25% out of the money, right? Pretty decent move. You wouldn't expect it to happen. But because Tesla can move a lot, there's still a lot of premium here. You can see almost $6.50 for that, which is 2%, right? So now 2% doesn't sound like a lot, but you don't have a whole lot of risk of Tesla. I mean, there's obviously risk, or you wouldn't be able to sell it for this much, but you don't have a ton of risk of Tesla going under 325 over the course of 3 months, right? Something pretty bad would have to happen for a stock like Tesla to drop that much. So it's 2%, but highly unlikely that you're going to have to do anything with this trade. Most likely it'll expire worthless. You think about if you do it every this is roughly 3 month trade. You do it every 3 months for roughly the same amount. You're making about 8% a year. That's about the average of buy and hold stocks, right? 8% a year is like the average, the long-term average of holding stocks. So not bad, right? I mean, you can obviously just hold stocks for that amount, but just as a comparison, not bad for something that's pretty far out of the money. So this is a situation there where you want to know more about Tesla. If you're going to do this every 3 months, you want to know what are the chances that Tesla's going to go under 325 and stay there, right? So you want to know a little bit about, well, what's their upside potential, right? Are people done with electric cars or does Tesla getting into a new area that's super interesting? So that sort of thing, right? You want to at least know a little bit about the company and more about it because it's a longer term trade. Okay. And we'll get to the stuff that I really think is important. And this is what I tend to focus on for my trading or my trading services, analyzing volatility and premiums. All right. So the price of a option can be explained in terms of its volatility, right? Its implied volatility. And that's really just how much the market expects it to move, right? Expects the stock to move, expects the option to move, but we'll just say the stock. Implied volatility is what the market suggests the stock is going to move over usually a 30-day period, right? So this is highly followed by option traders. It gives you an idea of how cheap or expensive a stock is. Generally speaking, higher volatility means higher income, right? Or premium, cash flow, whatever you want to call it. Higher cash, but also more risk, right? So it's just like anything else. It's a risk return trade-off. High volatility, it's high volatility for a reason. The question is it too high? That's a decision that you have to make when you're selling options or buying them. So you can use something like implied volatility rank or the percentile to gauge opportunity. So I just posted an example. This is from a site called Market Chameleon, options analytics site. They have a lot of great stuff. If you're looking for really in-depth stuff. So here we're looking at put premiums, and this was, I believe this was still for Tesla, but doesn't really matter just for the purposes of what you can see here is you can see a percentage, and this is, in this case, this is actually the percentage of the puts percentage compared to the price of the stock. So it's another way. It's very similar to implied volatility. It's another way of looking at it. Basically, the higher the put premium, the more expensive it is. Also the more risky. But just, the idea here is that you can see how far you are from the at the money. You're 1% away, you're 20% away, right? What that premium has been as a percent of the stock versus, where it is on average, where it, the low, the high, the ranking, right? You can look at this in terms of volatility, in terms of price. They are, for all intents and purposes, the same thing, right? Because price is determined by volatility, or volatility determines price, right? So all different ways of looking at the same thing. But for instance, if you're looking at, we'd probably be looking at something like 5% out of the money, or maybe 2% out of the money. If you look at the 52-week average, about 9%. You can see the low has been 4, the high has been 14. You see where it is now, right around the average, right? For both of these, -2, -5. So that's a case where you're like, okay, well, I'm not really getting a lot of info from this, but I'm not too worried that I'm selling when it's super cheap. And again, I'm not saying that that's sometimes you might want to sell something that's super cheap because there's not a lot of risk there. But sometimes you're not interested in collecting a very small percentage. You're interested in only selling when it gets to a certain level, right? So this will give you an idea, right? Again, you can look at this in terms of implied volatility. You can look at this in terms of price, but really good to kind of see where things have been and where they are now. All right, so let's look at another example. This is what I would consider a high volatility stock. This is IonQ, the quantum computing company, right? This one's been all over the place. It was trading it when it was under 20 earlier this year, and now it's 53. So obviously this thing moves a lot. You can see just on this day that I got this, it was down 8.5%. So this thing's going to move. So if we look at, again, roughly a 3-week trade here, just pick some out of the money strikes, right? 43 is a full $10, right? Full $10, almost 20% down, or you can say, about 10% down is about 47, 48, right? So I just did these kind of out of the money puts just to show you what kind of premiums are available for something that is really volatile. Okay, so let's just pick, one in the middle here, 45. All right. That is, as when I took this snapshot, $8 out of the money. So that's about 15%, 15% drop in 3 weeks. And you could still get a solid, $2. We'll use 2 for ease of math, right? That's a very, without even looking at where it has been, you can, that should strike you as a higher premium. Think about it in terms, and so an easy way to kind of think about that is, what would you expect is to get, let's say, per month? Now, I think 1% per month is a decent premium. Normally stuff that's not that volatile, you're lucky to get 0.5%. But for something that's kind of normal, you might get 1% a month. All right, this is a 3-week trade. What kind of percentage are we getting 15% out of the money? Well, easy way to do this is to convert this into percent. So 45 strike, 1% of that is 45 cents. Let's just round that up to 50 cents. 50 cents into $2 is 4%. So, you're getting at least 4% on a 15% down move in 3 weeks. Now, granted, we had a big move. This is around earnings. There's things going on. It's not normally going to be that way, but that should strike you. If you trade enough options, that should strike you as expensive. I'm getting 4% over a 3-week period for a stock that is 15% higher than this price. So that's kind of the way, like, you don't need to look at the past. You don't need to necessarily, it helps if you've traded IonQ and you know that normally, let's say you get 2%, so 4% is expensive. That's where it pays to kind of look at some of this information. But as a completely blind participant of this, you should already look at this and be able to say, dang, that just seems expensive. 4%, 50% down. I mean, just think about it in your head. And to me, that is important, because you don't necessarily need to get into these super fancy statistics and, stuff I look at, implied volatility versus, average implied volatility versus historical volatility, right? I'm getting into option skew and looking at change in skew. Like you don't have to look at that stuff to get a sense. If you just look at some of these numbers and you've ever looked at IonQ puts before, already you're kind of doing what I'm doing in your head, right? You should already be saying, wow, that looks expensive, right? If you've never traded IonQ or you've never traded puts, or, this might not mean anything to you, but typically you're going to trade something you've traded before, or there's always a first time. But so you are doing these things without necessarily knowing the terminology behind it. And I think that's important, right? I think that just because you don't necessarily know all the lingo and where to find everything, that's not necessarily important. It's helpful, but if you realize something is expensive, you're automatically doing some analysis in your head. All right. So, how do you manage your risk with something like this? Um, Diversifying is a little bit tough when it comes to selling puts because you want to go, as I'm saying, you want to go where the options are expensive. Now, a lot of times those might all be in the same sector or industry. And so that's fine, right? I try not to double up too much. Like I'm not going to do generally I'm not going to do more than one quantum computing stock in a trading portfolio at one time. I might do a bunch of tech stuff though, right? There might be a Tesla and INQ and AI, and a software, another type of software company in there, right? Right. So you're not going to be able to necessarily say, oh, I'm only going to do one tech or two tech. That's because if you go to, let's say, utilities or healthcare, the premiums just are likely aren't going to be there. So you can only diversify to some extent, but it doesn't mean you have to do all quantum computing stocks. I would try to avoid that. Um, Same thing in any risk management. Avoid over allocation to one stock, right? No matter how much you love something, how attractive 4% might be in IonQ, right? Obviously have a limit to how much you put in any one stock just because you never know. All right. The important part is if you don't want to take assignment, and I'm assuming you don't, you can roll or close early to manage it. So some people just have numbers, right? If I'm down, if this goes from two, so if there's a 50% loss or whatever, 50% increase in premium, if this goes from 2 to 3, I'm just going to cut it out. I'm going to take a loss. That's generally not how I do things, but I know plenty of people who do that, right? To me, option premiums move so much over short periods of time that you're going to get stopped out of good trades doing that end up working, but nothing wrong with having a system and sticking to it. Okay. More likely, what I do is roll, which just means that if INQ is at, let's say, goes down to 43 and we're near expiration, I might simply just roll it out a few more weeks and maybe down a little bit. Maybe I have to pay $1 to do so out of pocket, or maybe I go back up to 45 and I don't have to pay anything, or 46 because I assume it's going to bounce back, right? So there's decisions to make when you roll, but that will buy you more time. Sometimes, depending on how probable you want the success to be, it will cost you money out of pocket, but it doesn't have to, right? If you feel like it's way oversold, it's going to bounce back, then maybe you stick at the same strike and you don't have to pay any money. So, or very little. So, or you can even sometimes do it for a credit. So there's different ways to roll, but that's generally how I do stuff. As long as my thesis doesn't change, I will usually roll stuff out. And of course, maintain sufficient cash coverage. That kind of has to go with don't over allocating. So don't do too many trades that you're draining all your cash. You want to leave some bullets there, on the side in case there's a really great opportunity. You want to double up, or just generally speaking, good for any sort of trading strategy. All right, this is kind of the key here. I'm going to start with the middle point here. Volatility is elevated. This is what I've been trying to kind of push. I don't think you should trade cash secured puts to get ownership of a stock. Right? There are strategies that do that. And I'm going to talk about the wheel here in a bit, which is somewhat like that. But the reason you should sell a put, first and foremost, is because it's expensive. There are reams of statistical data, PhD papers, right? Like you can do, search and get 100 papers on, Google on selling expensive premium and options, right? There is a real edge to that. And typically, there's a couple ways you can look at that: is implied volatility versus where implied volatility normally is. like in a volatility cone sort of structure, where a volatility is elevated, but it's normally lower. Another way to do it is look at a historical volatility. You can look at where the stock has moved and where the options are priced and see, okay, well, stock is only moving 10%, but the options are saying 30%. Is there a reason for that? Or does that just seem expensive? Sell options, right? So don't just pick a stock that's been moving a lot and has a lot of premium and say, oh, I'm going to sell this. It's moving a lot, looks expensive. So this is where, yes, with IonQ, I'm saying, oh, this looks really expensive. You should sell it, but you should make sure if this is the first time you've ever traded IonQ, you should make sure that that's actually expensive, right? Find an implied volatility chart. Say, well, hey, it's trading at, it's not listed here, but I think it's 110% volatility in this case. Look and see if that's low. You can find implied volatility charts pretty much with any brokerage for free, right? You can say, oh, well, normally it trades at 150. So 110 is actually cheap. Now, again, if you've traded IonQ in the past, you probably know just by looking at it that might be expensive. And I imagine that this is probably expensive. I haven't traded IonQ in a while, but I imagine 110% volatility is probably pretty expensive without even looking at it. Even though I haven't looked at it in a while, but maybe not. Maybe I'm wrong. Maybe that's low. I think it's actually in the 60th percentile. I think I did look it up. And normally it's probably like 80%. So 100%, 10% is expensive, right? But that's something that you want to look at. Don't just look at this. Again, kind of going back, I said, if you looked at it and you've traded it in the past and it looks expensive, you're probably fine selling it. But if you're not sure, and even if you are pretty sure, I would still look this up. Make sure it's expensive. Don't just trade something because it's got a high premium. Make sure that it's actually higher than it normally is. Whether it's because of earnings or whatever else. I mean, just because there's earnings doesn't mean that options can't get more expensive, right? So earnings might be projected a 10% move, and this time it's projected a 15% move. And there's no reason to believe that the earnings are going to be any different than in the past, right? So know why, to some extent, the options are priced where they are, but look for expensive options. That's probably the single best thing you can do to give yourself better odds. Market is mildly bullish or range bound. This is most of the time, right? The reason it's not just plain bullish is because, yeah, if its stocks are going straight up, you're probably better off buying the stock, buying a call, doing something else, right? If you're trying to get upside exposure to something, there are better ways to do it. Right? So selling options are better if the market's kind of going up slowly, right? Or it's range bound, it's dropped and you think it's going to rebound. So that sort of thing. Obviously, things are going straight down. You don't want to sell puts. Things are going straight up. There are better ways to make money. You can still sell cash secure puts, but you might be leaving money on the table by not taking a more aggressive position. And then this is good. Again, this is not a home run trade. This is consistent cash flow income, whatever you want to call it, where your risk is defined. You're looking for, maybe it's per week or per month, some percentage, right? The Tesla example, we were looking at 8% a year for what should be a very low risk trade. Now you could take a little bit more risk and maybe get that to 12%, right? Or maybe you're trying to get 25% and you're willing to put on quite a bit more risk, but you have pretty tight bounds on how you're going to roll your trades or close out trades and manage your risk and that sort of thing, right? So the key there is consistency. All right, when to be cautious, as I mentioned during market downturns. Just because if you're going to be at the start of, a month or weeks or even days of selling, right? You don't want to get too underwater to where selling premium is not going to make that much of a dent in your loss. So obviously, we all love to avoid market downturns. It's not always possible, but if there's a lot of bad news coming out, maybe hold off a little bit and see how things play out. You don't need to avoid in a major market run. Again, as I'm saying, you're still going to make money on cash secure puts, but you might leave money on the table. So you don't have to be cautious. It's just there might be better ways to play that. A liquid stock's going to be very hard, to get out of when you need to. Sometimes to get in, but a lot of times to get out. So be careful with liquid stocks. Of course, speculative, that's more what I'm saying. Like, IonQ is a speculative stock, I would say, although it's been trading now for a while. But, I wouldn't put all your eggs in a basket of something that can easily move 8% in a day, right? That's generally not the sort of thing that, now this might have been earnings. If that's the case, that's a little bit different, but I've seen IonQ move 8% other days, right? So if it's speculative, you just want to be more careful. If it's ridiculously speculative, like it moves 20% a day, or it's a biotech that's waiting on an announcement from the FDA, right? That's stuff you want to avoid, period, in my opinion. Low volatility. All right. Now, low volatility can be an okay strategy if you're just trying to amplify, already a low uh, dividend sort of position, right? Maybe it's like a utility and you're getting 1% and maybe you're doing a covered call or a cash secure put to try to get that to 2% a quarter, whatever. That's fine. And that's not going to hurt. But generally speaking, low volatility, there's not a whole lot of reason to do those. Right? You're better off probably buying options in that case and hoping that it moves, or just not trading it if it's not going to move, or owning the stock and collecting a dividend. Right? A lot of really high dividend stocks are not going to be worth doing options on because there's no premium there. So you're better off just not capping it, or you're not putting on that extra risk and just collecting the dividend. All right. So the key here, cash flow generation with defined risk. That's why I really like this. I think you should focus on the premium collection. In other words, expensive options, not stock ownership. Now, the exception is the wheel, which is a product that I have. So I'll talk about that in 1 second. But also, this is a way to combine, call it technical and fundamental analysis, right? Fundamentals, particularly if you're doing longer term, you want to know some stuff about the stock, you want to know stuff about the options. I had option premium can be considered more technical. I would say that's more quantitative. I'd do a third category. Quantitative analysis for options, make sure that the options are expensive. Technical, right? If the stock is running straight up, right? It's probably not a good time to sell a put because either it might rebound, or if you think it's going to keep going up, then buy a call or something like that, buy the stock. Right? I think the fundamentals for particularly for longer term trades, make sure it's a company you trust that's not going to shoot down. All right, this comes into play a little bit more with the wheel. So the wheel is a strategy that I love, where if you get if you sell a put, you start out by selling cash secure put, just like we talked about. If the stock drops below your put, instead of rolling it or closing it, you do take ownership, and then you the next week sell a covered call. And then if it goes up to that call strike, you can be aggressive with it, gets called away, you get back in by selling a put. This is really good with higher volatility stocks that tend to trade in a range. You might be in a trade for a while, so this is why the fundamentals matter a little bit more. The key here with the wheel is that just because you might take ownership doesn't mean you should ignore the premium collection. I still only do these trades if the puts are expensive, right? Now, I spend a little bit more time studying the stock than I would with a normal cash secure put trade, just because we might own it and sell a covered call. But that doesn't mean my main focus is not the option part of it. All right, so if you're interested in that, I have a product called NetPicks Option Wheel here. It's getnetpicks.com now. So if you're interested in that, please check it out. And yeah, so that's that product. But that's pretty much what I have. So I can answer questions now. Talked for a while. So happy to answer whatever questions you may have. Let me see. Are those in chat here? Oh, thanks, Casey. All right. Yeah, feel free to throw any questions you have. Always happy to answer questions. Any questions on anything, any topic, football, options. Oh, thank you, Dave. I believe the price is, I don't set the price. I believe it's 597 a year. So that's how much it was the last time we sold it. So I'm assuming that's the price again. Yeah, 597 was the annual cost. I'm assuming that's what it'll be. I'm just the options analyst. I don't know how to price products. That's why I let other people do that. The questions, anything about Wheel, Cash Secure Puts? Am I a fan of the Dodgers? No, I was rooting for the Blue Jays because I'm from Kansas City originally and I'm a Royals fan. So I like although I wouldn't necessarily consider the Dodgers small. I mean, the Blue Jays small market, but they're a little bit closer to the Royals than they are to the Dodgers. So Mike asks, is option premium treated as short-term capital gains? Can be used to offset stock losses, or are they treated as ordinary income for regular traders? Not a tax guy, but options, unless you hold them for a very long period, the same period, it's just like a stock, right? It's going to be ordinary income, unless you're it's like if you're doing like a long-term covered call trade where you're holding it enough for your stock to be a capital gain, then I believe the options will be. But the vast majority of the trades I do are short term, so they're going to be ordinary income. Sadly, but that is the reality. But my feeling on taxes is that if you're making enough money to where you have to pay a lot of taxes, then you're doing well. That's my philosophy on taxes. But I always recommend talking to a tax accountant if you have questions about that. Also, if you can do this stuff in an IRA, most of my subscribers, I would say, use their IRA for stuff like the wheel. That's obviously the great way to do it, right? Because you can sell options in an IRA or a Roth. That's perfectly fine, and every broker will let you do that. Well, every U.S. broker that I'm aware of will let you do that. Great question, though. Anybody else? We got some time here, but didn't quite take quite as long to go through everything as I thought. But so happy to stick around and chat. Well, David, I guess didn't quite
Testing
take as
one,
much
two.
time as I thought it might.
Do you have
Testing
any
one,
other?
two.
Sorry, was that?
Uh, David, yeah, yeah, I can hear you. What? Um, Jay, do you have any other examples or anything you could share?
Um, I'm nothing set up. I can go to share my screen, or I can go to Market Chameleon and walk through some stuff. That's fine. When I timed this out before, it had taken a lot longer, but I guess I spoke faster, or maybe I expected more questions. I don't know, but yeah, I
Uh,
mean, yeah.
yeah, if you want to. Um,
All right, here,
or
let me stop my share for a second here. Let's find something. So you have some time to kill. So I want to keep people occupied until the next person is ready.
Hello, hello, hello.
uh, yes, David, we can hear you.
Yep.
Okay, are you ready for me or not yet?
Oh, oh.
Um, Jay, did you want to share
Uh,
those examples?
yeah. I mean, if David would prefer to go, we can do that, or I can share examples for a
Go
little
ahead.
bit.
You can go ahead and I'll wait.
I'll just
Yeah,
I'll just spend like 5 minutes or whatever, and then we can try to keep you on schedule. So let
yeah,
me
you
share.
you have almost 20 minutes still technically. So,
Gotcha. Okay. All right. Can everyone see this here?
yeah, Market Chameleon, yeah.
Yeah. All right. So this is Market Chameleon. Um, Great site for options analytics. If you're if you're looking for it. I think it's $99 a month, but totally worth it if you're a regular options trader. So here, so let's look at this is one thing I would have shown. Again, I thought my presentation was going to take longer. Otherwise, I would have put these slides in. But one thing I think is important, we are talking about volatility and expensive volatility. So first off, you can see here, when I was looking at that, IonQ implied volatility was about 110%. And it was above, it was close, I think it was like 55, maybe 58% of its rank for the year. It's down a little bit. Now it's at 48%. So you can see that it is still, it's about the average, right? It's about where it is for the year. So I mean, generally speaking, is it expensive? It's right around where it's right around the average, right? So, but you can look at that graphically, which is nice here. So here's the implied volatility, right? This is the at the money implied volatility. You can see that it has stayed relatively above 100 for a lot of it. Did drop down a little bit during the summer. Earnings don't seem to impact it as much because the volatility is already so high. You're not seeing the implied volatility run up into earnings, which is relatively normal for stocks. But just because I think it's such a high volatility stock, it remains elevated most of the time. So first off, you can look at what um, implied volatility has done, and it's kind of dropped below its average. So does that mean you shouldn't sell options? Well, not necessarily. You can look at also something like the historical volatility, the purple line, which is the last 20 days of what the stock has done. All right, now I'm looking at it. It's actually a little bit cheaper than what the stock has done and a little bit cheaper what it normally is. So at this point, I may say, you know what, I don't really want to sell this option anymore because it doesn't really look that expensive. As nice as those premiums looked generally overall, they don't really look as cheap as I might like to see. So what's another one we looked at? So UAL. This is going to be a much lower volatility stock, even though airlines are, have their volatile periods. You could see this one's at a 47% volatility. That's about the 40th percentile. All right, you can see this one does tend to go up into earnings. Right now, it's right about its implied volatility average. Let's look at the historical. It's also right about at the historical. So this one also kind of fair priced options, just based on these couple metrics. There's lots of different ways to look at this stuff. I'm just cherry picking a few metrics that we talked about. But according to some of these metrics that we've looked at, none of these are particularly expensive. All right, let's look at the third one we looked at was Tesla. All right, they've recently had earnings. All right, this one is 57%. This is almost at the bottom third. So looks a little bit cheaper. So we might actually have one that will work in terms of looking expensive. Let's see. All right. All right. So here we finally have, you can see a divergence where the historical's down, but the implied volatility is moving up. Not big, but there is a difference here, about 8%. And we're right around where the average is for the implied volatility. But this might be a case where you say, okay, options do look a little bit expensive here. So this might be a case where then you can say, all right, I'm gonna find something, maybe we'll go out again, something like 3 weeks. Let's see, it depends on how safe do you want it to be? Do you want to be 10%? Right? I mean, these are very expensive options because of how much Tesla can move. Oops, sorry, 10% out of the money. And that's why they were that expensive, but this makes a little bit more sense. Still expensive, not quite as crazy. You're still, getting $8.50, right? But keep in mind, you have to put up $41,000 in a cash secured account to make a trade like this. This is where people like to use credit spreads and things like that, which is outside the scope of my talk, but that's how you reduce your capital requirement by doing a spread. But let's just say, you have that money, right? This is about 2% in 3 weeks. Not bad, right? I mean, $860, about a little over 2%. And you have 10% cushion for 3 weeks. not bad, right? So that's a decent example. I would do a much cheaper stock, so you don't have to have all the capital requirement, but pretty good example. All right. So with that being said, any questions now that kind of looked at some of this stuff or all right. Well, David, I think that's probably as much as I can muster.